the Consumer Price Index report reaffirmed that the US Fed and the Bank of Canada will continue raising interest rates. We're going to talk about that news and how it's going to impact home prices in the months ahead. We'll also talk about why you may consider buying a home even if you expect prices to fall further. I hope the insights from this channel help you manage your money and investments. Hit the like, subscribe, and hit the notifications bell to join the community and participate with your own insights. Everyone is worried about inflation becoming entrenched and how high interest rates might climb. In that scenario, people are concerned that the value of their homes, stocks, bonds, crypto would depreciate in value. In today's CPI report, we didn't get the numbers we had hoped to see, but it wasn't all bad news. Markets anticipated that inflation would come down from 8.5% to 8.1% in the US. Instead, we saw an 8.3% inflation since April 2021. Analysts had forecasted that month-over-month headline inflation would be 0.2%. It turned out to be 0.3%. The good news from this report is that core inflation actually slowed down this month to 0.6% from last month's gain of 1.2%. That means core inflation is still annualizing at a rate of 7.2%. Central banks will manage this high inflation by raising interest rates, but they have to balance it so that they don't risk crashing the economic recovery. We're already starting to see lower home, stock, crypto, and bond values. That starts the destruction of the wealth effect. The wealth effect is a term used to describe people's spending habits when their assets fluctuate in value as they are right now. Based on today's high inflation numbers, analysts expect that interest rates might rise as much as 1.5% by the central bank's September meeting. That'll mean that borrowing rates on variable rate mortgages will have climbed 1.75 to 2.25% since they began increasing in March 2022. Since then, home prices have been falling in most regions and housing segments. There are some areas that have held up better, but those are the exceptions to what's happening more broadly. We will see a combination of factors put additional downward pressure on prices in the coming months. Any mortgage rate hold since mid-January has expired, and anyone new to the market will be asking for a 5-year fixed rate at 4.5% and will have a qualifying payment based on a rate of 6.5%. As a result, new home buyers will have around 13% less borrowing capacity than the peak at the start of February. When borrowing costs rise, this also affects the price of a gifted down payment. Typically, when a family member gives a gift, they're doing it from borrowing from their own home equity. That's often done on a home line of credit. This product is based on a variable rate that also changes when the Bank of Canada's rate fluctuates as well. By September, the prime lending rate will likely have increased to between 1.75 to 2.25%. So parents will be more reluctant to borrow from their own equity at higher rates as they approach retirement. They may also be reluctant to cash their stock and bond investments below their peak value. We're in a high interest rate environment, so they could be earning a greater rate of return on the money they have set aside right now. We're in a rising rate environment, so they can earn a greater rate of interest than they have in recent years. Property inventories are also rising, including downtown Toronto, and poorly cash flowing rental properties can be a real burden as interest rates rise. I anticipate that over the summer months, we're going to see additional inventory come onto the market, creating more of a buyer's market. I firmly believe that interest rates are the greatest driving factor of home prices, but I also think that fiscal policy is going to help to slow down demand as well. An increase in the foreign buyers tax and an economic slowdown globally is going to help curb foreign buyers as well, disproportionately affecting the Greater Toronto area. Here comes the twist. Despite some of the price pressures that I've discussed, I actually think now is a great time to buy a home. We are entering a buyer's market with fewer offers, more inventory, and more room to add contingencies to your offer. Prices have already softened, and predicting a market bottom is a fool's errand. Find your family an ideal place to live and enjoy the fruits of that decision over a 5-10 year window. Buying a primary residence is a foundation of financial security, but it shouldn't be viewed as a speculative investment. If you're an investor, then do your homework. Determine what rental rates you're going to need in order to carry the cost of your property at current depreciated prices. Borrowing costs have risen, but rental rates have as well. Home prices have also come down, which means that you need a smaller mortgage financing in order to close on a home. I expect to see more single-family homes for sale in the coming months. Seek out some layouts that give you an opportunity to create additional units to increase your rental yield. Even if you choose to speculate and sit on the sidelines for now, take this opportunity to determine how much you have available as a down payment and how much mortgage you qualify for. You can pull the trigger when you feel the time is right. Please hit the like button, subscribe, and hit the notifications bell to join the community and build your finance knowledge. See you in the next video.